The China in Africa podcast is brought to you in partnership with the Africa-China Reporting Project at Wits University in Johannesburg. The ACRP promotes balanced, considered reporting on China-Africa relations through training programs held throughout the year. More information at africachinareporting.com.
Hello and welcome to another edition of the China in Africa podcast. I'm Eric Olander, and as always, I'm joined by CGSP's managing editor, Kobus van Staden, who's joining us on the line as usual from Johannesburg, South Africa. A very good afternoon to you, Kobus.
Good afternoon.
Kobus, today we're going to be talking about debt. It's a story, of course, that longtime listeners of the show will know that we've covered intensively over the past 10 years, but really in the past 2 or 3 years, it's been a major topic of conversation. And now there's a lot that's going on just in the past few weeks that I want to bring you up to date on. Ivory Coast went back out into the debt market. In fact, it's the first African country in 2 years to get into the bond market to raise money. It generated $2.6 billion through 2 bonds that had terms of 8 years and 13 years. And Kobus, this is what's interesting. Both of those were at single-digit interest rates. So one of the things that we've seen over the years is how there's been a premium on African debt that's put into double-digit rates. The Ivorians got a good price on those, and that's given some hope to other countries seeking to raise capital again. The Bank of Uganda this week also raised some money, $331 million, in what's called a private placement, where only certain banks are invited to participate. So not a public placement where it's on the open market, but they basically invited a series of banks and generated a few $100 million there. Now, the Kenyan government this week also announced that it feels that it's also the time is right to dive back into the bond market. Now, get this, Kobus. The Kenyans are going to try and generate billions of dollars on a new 7-year bond in order to pay back a $2 billion Eurobond payment that's coming due later this year. So they're raising money to pay back money. That's not the best thing, but again, it's just the reality of where we are. But the situation in Kenya highlights the problems that a lot of African countries are facing when it comes to managing their debts. These bonds are priced in dollars, and that means when the value of the dollar goes up, the value of the shilling or the local African currency goes down. So the Kenyans are now going to need a lot more shillings to pay back those loans because the shilling has been under tremendous pressure for much of the past year. And the Central Bank of Kenya came back with a report this week that said they owe a lot more money. They said that basically now the country's total debt has increased by $2.8 billion just because of the devaluation of the shilling against the dollar. That puts the total public debt in Kenya now at about $68 billion. And just for those keeping track at home, the Chinese account for about 8 to 9% of that. But listen, the Kenyans can take cold comfort that at least they're not Zambians. Zambian Finance Minister Situmbeko Musukwatani said this week that he's hoping the country's official creditors, led by the Chinese, will work out their differences with private creditors. And somehow in the next 6 months, he's hoping they're all going to come together and finally reach a deal to restructure the country's $13 billion of external debt that is now going into the 3rd year. Kobus, can you imagine? We've been talking about Zambian debt restructuring for 3 years now, and it's just stuck. The problem is that the bondholders think that the Chinese and the other bilateral creditors are getting some kind of sweetheart deal. The Chinese, in turn, they shut down the process back in January because they said the bondholders are getting preferential treatment. Meantime, Zambians are left largely powerless to do anything. And Kobus, you would think that an institution, say, like the International Monetary Fund, we've talked about the G20, we've talked about a lot of multilateral institutions that would be ideally positioned in situations like this to come and bring the parties together to find some kind of resolution. But that isn't happening. Since the beginning of the pandemic, you and I have been following how the IMF, the G20, and all of these other groups are either unwilling or unable to handle this crisis. And as you've noted on a number of occasions, that's really left the smallest and the most vulnerable countries really to fend for themselves. And it's just tragic to watch what's happening.
Yeah, it's very disturbing to see the fallout of this because, obviously, as we're seeing in Zambia, we're now talking about a generation of children that are growing up under essentially unending government austerity. And many countries now pay a lot more on servicing debt than they pay on healthcare, for example. So this isn't great. What we're also seeing, and I think this is the kind of wider landscape, is that due to the rapidly growing complexity of the number of lenders involved, due to the rise of China, and, partly due to the kind of political blocks, I think, in Western countries, we're coming up to a very strong need for global financial reform and a very few tools to actually implement that reform. And over the last 2 years or so, we've seen increasing calls for this kind of reform and not very many kind of avenues open to actually make that happen. So countries like Zambia are kind of stuck, as global powers are kind of fighting around these frequently kind of philosophical issues of who takes which kind of haircut, for example, in the wider kind of like discussion about how global international development finance is going to work in the 21st century.
And to be sure, this is not only a situation that's taking place in Zambia. Sri Lanka is in very much a similar situation where the major bilateral and bondholder creditors are not really working hand in hand. So it raises the question of where do we go from here? Who is actually going to help resolve this situation? And we were thrilled to have the chance to publish a fascinating article on the subject. Who will come to the rescue? The inadequacies of the global financial safety net and its impact on developing countries. It was written by Bill Kring, who's the executive director of the Boston University Global Development Policy Center, and Marina Zucker-Marques, who is a postdoctoral researcher with the Center for Sustainable Finance at the University of London. Bill and Marina both join us on the line today. A very good day to both of you.
Thanks for having us.
Thank you, Eric. It's a pleasure.
It's great to have you both here. Bill, let's start with you. You raised the question in the title, who will come to the rescue? Who is going to be the Superman, Superwoman to come in and save the day for a country like Zambia?
Well, ideally, the global financial safety net, which is a big phrase for essentially what is a network of institutions, including the International Monetary Fund, bilateral swap arrangements with central banks, and in regional financial arrangements that are a key component to the global financial architecture. And that's where countries, are supposed to turn for liquidity financing when there's a crisis. But what research shows by us at the GDP Center and by our colleagues at Free University of Berlin in partnership with the United Nations Conference on Trade and Development is that actually the GFSN is fundamentally flawed. There are big gaps in the GFSN in terms of the coverage of which countries can actually get the resources they need. There are big disparities in terms of the cost of acquiring those resources. And ultimately, a lot of countries just lack any potential resources through the GFSN and fall through that net.
Marina, through our discussion, we've been citing these crisis countries like Zambia, for example. Can you give us an idea of how much a debt-distressed country like Zambia going through debt renegotiations, like how much depends on decision-making among Zambian policymakers? How much power do they have to affect the outcome? And to which extent are they basically just beholden to other more powerful actors, or to which extent can they actually maneuver and pivot to try and make the situation better?
Yeah, that's a very good question, because for a lot of countries, and especially in Africa, this is the case of Zambia, when countries go to crisis, so the first line of defense is often foreign reserves. But when countries go to this kind of crisis, they end up using the reserves for imports or because their currency devaluates, and to stabilize, they need to use the reserves. So the second line of defense could be, for instance, SDRs, but until very recently, there was not enough. And recently, we have, in 2021, a new issuance that could be used, but often they also is not enough because the allocation is different. So countries like Zambia, they have to go to the IMF because there is no regional financial arrangement in Africa. Some countries, they do not have access to swaps. So even Chinese swaps that service some developing countries, some middle-income countries, they are not available for countries like Zambia. Swaps from the Fed, even less probability that it would serve countries as Zambia. So they don't have much to run, Now we are seeing more and more like South-South cooperation in the financial arrangements. But most countries, they do not have other options but to go to the IMF And it means going through austerity, very complicated procedures, and they are often no access to the bond markets. So they have to rely on this very complicated negotiation and IMF lending.
Okay, so Marina, before we get too far into the weeds here, there were two concepts that you raised there. You mentioned SDRs, those are special drawing rights, and currency swaps. Just for those of us who are a little bit new to this field, can you explain what is an SDR and also what is a currency swap?
So special drawing rights, they are, as the name says, it's a right to access some pool of reserves organized by the IMF. It's not IMF resources, but IMF members' resources, which each country, based on the quotas, they can access these new resources that are created. So in 2021, we have a new allocation of $650 billion. So if a country, for instance, has 1% of IMF quotas, they can access 1% of SDRs. And this can be exchanged for dollars or any currency that belongs to the basket of currencies of the special drawing rights, which today is dollar, euros, sterling, yen, and RMB.
Okay, so currency swaps now. What are currency swaps?
So currency swaps are arrangements between two central banks. And I like to compare currency swaps to a bank overdraft. So when it's not a debt itself, it's much more like an insurance. So when we look to our bank account, the bank can give us, $1,000 of overdraft. You probably don't use it, but if you need it, you know that you can access this. So currency swaps is this logic. So there are insurance, there are arrangements between two central banks that if one country needs to access foreign currency, they can give the central bank A offers a credit line to central bank B. And as a collateral, central bank B gives their own currency as an insurance that they are going to, repay the loan. So it works like in an overdraft. It's often not used, but just the existence of swaps can eliminate distrust in the market.
Okay, so that's really helpful. Bill, we've been hearing a lot about currency swaps with the Chinese in Pakistan, also in Argentina, where they just cut off a currency swap line. And in many ways, the currency swaps seem to be playing a role of the global financial safety net. And you guys write in your article that there's about $1 trillion in active currency swaps, and 40% of that is provided by the People's Bank of China. Can you talk to us a little bit about the role that currency swaps are playing in this financial safety net you're talking about, and whether or not that should be part of the financial safety net, or this is a poor replacement for the safety net that's not there?
Sure. Yeah, the global financial safety net really has increasingly become reliant on bilateral swap arrangements. If we think of the kind of key components over the last decades, the International Monetary Fund and its firepower, which you referenced in an earlier question, has not kept pace with the growing dynamism of the global economy. And essentially what I mean is, if you look at the overall size of the global financial safety net, it's about 1% of total global financial assets. And that's including all of the components that I mentioned earlier. So the International Monetary Fund has really not kept pace in terms of the lending firepower that it needs. Countries have created these alternatives called regional financial arrangements that largely supplement, or in some places have kind of replaced traditional lending by the IMF through the global financial safety net. But those resources also really don't fill all of the gaps in the global financial safety net. So swaps have emerged in the lead up to the COVID-19 crisis and in the aftermath as the most used component of the global financial safety net. And in part, that's because of the ease of using them. But to your point, it creates a number of challenges for equitable distribution of resources across the global economy for liquidity. Namely, that they can be inherently political. Countries can choose who they give them to. But likewise, when you look at the landscape of swaps, there are only a handful of countries that ultimately get them. And typically countries are looking at trading partners that are important to them, or they're looking at strategic allies. And then, of course, you have different classes of swaps, with unlimited swaps being issued by the six major central banks of the world.
So, Bill, following up on this explanation, there's been a lot of discussion, among scholars and so on who look at this about the one aspect of the IMF not keeping up with the dynamism of the global economy, which is shareholdership and voting share. And with that, kind of the possibility of reforming the kind of the arrangement of votes within the IMF. I wonder if you could explain a little bit how that works and where we are now historically in that process.
That's a great point to raise. Quota reform really was one of the key issues with respect to those following the global financial architecture throughout 2023. And what we found at our research in the GDP Center, in partnership with our colleagues at CATS, the Chinese Academy of Social Sciences Institute for World Economics and Politics, was that IMF shareholders have to commit to conducting general review of quotas per the Articles of Agreement on a regular cadence. And at times that has slipped. And when there has been a review, they really have kicked the can down the road. The IMF's quota-based resources, as I said, are insufficient. Those need to be scaled up. But also the composition of IMF funding in the aftermath of the 2007-2008 financial crisis became one where the IMF increasingly relied on borrowed resources, temporary resources. So countries had their paid-in quota, which was their share of that they bought into the IMF that created the permanent quota base of IMF lending. But that wasn't nearly big enough for the challenges that the global economy faced. So they've augmented it over time with temporary sources of resources. And, what we said was those really need to become more permanent, number one. But most importantly, the resources need to be realigned so that members' quota shares reflect their actual weight in the global economy. And there are significant shortcomings there in terms of voice and representation at the IMF. And so the 16th General Review of Quotas really provided an opportunity in 2023 for the IMF shareholders to try to get it right. And unfortunately, what came out of the annual meetings in Marrakesh and the board voted on was increasing the permanent quota base through an allocation of quotas that was going to be equiproportional. And what that means is countries would be allocated a percentage of the new quotas based on the current quota base they have at the fund. So there's no realignment of quota shares. And number two, the increase in permanent quota-based resources was going to lead to a drawdown, or will lead to a drawdown of the temporary sources, and those will be phased out. So essentially what the IMF has done is kept the same voting structure in place and quota share system in place in terms of the distribution of them. It has, of course, made the resources permanent, which is definitely a good thing. But at the end of the day, there was no realignment of the quota shares. And they have, committed in the 17th General Review of Quotas to reevaluating what the quota formula is. But unfortunately, as some have pointed out, this really could lock in for a long time the current quota distribution at the fund, because it was such a significant increase, but again, along equiproportional lines where every country basically stays at the quota share that they have.
But this is something that I've never understood. China today accounts for somewhere between 18 and 20% of the global economy, yet only has, I think it's about 6% of the IMF's voting share. Isn't it supposed to be proportional? Shouldn't China be at around 20%?
Yeah, so definitely China and other emerging market and developing economies have long called for a reform to the governance of the international financial system. And the IMF is a case in point. And as a crucial anchor of the GFSN, really we need to be thinking about how can it be effective as a multilateral institution. And unfortunately, with no reallocation, no realignment of quota shares in the 16th review, it really is a failure. The one kind of the light at the end of the tunnel, or the opportunity, just to not be completely pessimistic about it, is the fund definitely recognizes that EMDEs really want more voice and representation, and that they deserve more voice and representation, and that it's to your point, it's kind of laughable at times to see when you look across the landscape of multilateral institutions how out of sync voice and representation can be. And so they have committed to looking seriously at the actual quota formula, which is the formula that determines the allocation of quota shares. And that's going to be a really important opportunity. And certainly it's something that I'll be looking at in my research in 2024 as to how can that quota formula be improved to ensure that there is an alignment of quota shares that is more indicative or more emblematic of the realities of the global economy.
Marina, over the last 2-3 years, as we've faced this new kind of wave of debt distress, there's been a lot of discussions about whether the multilateral development bank's position needs to change. And that discussion has been particularly kind of pushed from the Chinese side, that have really, like the Chinese stakeholders have really kind of chafed against, for example, the idea that the World Bank is a kind of a lender of last resort that can't take any losses. So, from your position of having looked at these processes, what kind of options are open to what kind of new roles are open to the multilateral development banks? Like what are some of the ways that their position might be, kind of shifted in order to make the entire system work more efficiently?
Yeah, so multilateral development banks are actually thought to be long-term investment financing. So when you look to the global financial safety net, you often think about very short-term, fast access to liquidity. And that's why organizations like the IMF or regional financial arrangements or swaps are very useful for times of crisis. What now there are also the discussions is that we also need more volume of finance and development finance, liquidity finance. Bill mentioned the question of the IMF size. We have done research that shows that if the IMF was actually up to the task to serve the emerging market developing countries' needs in terms of size, the increase of the quota should be over 250%. And recently we have 50% with reduction in the long term of financing from other sources. So actually no real increase. So we need overall an increase of resources for emerging financing, which should be the global financial safety net, but also the development finance. And I think maybe because the global financial safety net has a lot of problems, we are trying to find resources from other ways. And the multilateral development banks that should be longer time investment, to increase the productive capacity of countries and help them, overcome underdevelopment. We are also seeing them as a source of shorter-term liquidity. But also there is this question that we need more fast disbursement from these institutions. They often take very long time to have projects approved, and then the project actually with finance disbursed, and then many years to have the project complete. So with shorter time period of finance, this could actually also help from the liquidity perspective of countries. So if they had the possibility to have a fast disbursement. But I think overall, there's need to make finance, being them development finance or the global financial safety net, short term, overall bigger and faster.
We've talked a lot about the IMF. The question of China does oftentimes come up in this conversation. Marina, you have done a lot of research on the role of bondholders, and bonds are really the big player here. This week, as I've talked about in my introduction, it's all about going back into the bond markets. The scale of the bond debt has been the problem in many of these countries. So when we look at Sri Lanka, Zambia, and Ghana, they did not fall behind on their payments on Chinese debts. They fell behind on their payments to bondholders. Last fall, you wrote an article, Winner Takes All Twice, How Bondholders Triumph Before and After Debt Restructuring. Let's talk a little bit about now the role of bondholders and how there's been very little pressure, if any pressure, on them to make any kind of concession or accommodation, either from their host governments in the UK and New York, where most of the bonds are under their jurisdiction, but also from any external pressure that the bondholders basically have not had to reform at all in this situation. Give us the take and what your research has told us about the situation of bondholders in this process.
Yes, of course. So we have the economic theory often relates risk to the cost of capital, right? So if you lend more expensively to a country or to a project and it's a riskier, you are accounting that you may have the risk of default. You often charge a premium for this. And this is the case of the bondholders lending for emerging market developing economies. So this theory, and we see this in practice, when we see lending prices for developing countries, it's much more expensive than lending to advanced countries or to the US. So this should compensate ex ante the debt relief. So they're already counting. If some countries default, it's already, the cost of it is already compensated. And we know that very few countries, like historically, if you see the number of defaults that we have, is actually very small. So some count to about historically 2% of the bonds. So what we would expect from the research point of view. So if we're already charging for the possibility of default, maybe when we have default, the bondholders would finally accept the losses. But this is not what we see. Actually, when we see the refinancing position of bondholders, the cost of the new restructured bonds, they're actually as expensive as it was before. So we see there is no actually losses in terms of pricing, which made you question at the first instance, like, why are you charging so much if when actually you go to default, you're not absorbing comparable losses? So this is the case that we saw, for instance, in Zambia, that we did our blog post, also with Suriname. So we would expect better deals with bondholders, and it's not what is happening now.
Bill, following up on that, I wonder if you could talk a little bit about the political economy of the bond market. Like, one of the things that really struck me, as we, particularly from an African perspective, as we've gone through this crisis in Zambia and other countries, has been that US policymakers very frequently single out China as uniquely problematic. I don't think Janet Yellen, the US Treasury Secretary, has repeatedly said that over the last 2 or 3 years, at some stage calling China a roadblock to effective, debt renegotiation. But at the same time, kind of as Marina was pointing out, private lenders that are frequently based in New York and London, Frankfurt and so on, play a big complicating role in this crisis. So I wonder if you could talk a little bit about what is the relationship between Western policymakers and the Western kind of private financial industry, and what kind of leverage do policymakers actually have over the financial industry?
Okay, I will maybe answer more broadly. So I think the problem so far is that we try to find a single solution to the debt crisis, and there is no single solution, right? So it's a combination of course, increasing financing, increasing in the price of financing, also decline of new resources for developing countries, the interest rate hike, all combined, and plus COVID. And this combination of problems are causing the crisis in developing countries. So China is not the single reason, but I think one important driver has been the increase of financing through the bondholders, because they are the most expensive financing. So if you go, for instance, concessional loan from such development banks is like 1%, more or less. Lending from bondholders is going to be basic rates from the Fed funds, plus a very large, much larger cost, which can reach now over 10% for some countries. So this very high source of borrowing has been one of the drivers for the current debt crisis. And this is also a way actually and when we look to the Western finance, it's also the increase of borrowing from private market is also compensating the lack of, new resources that are not debt financing. So, not increase enough of ODAs, that outward development finance assistance, no substantive increase in exports. And this led these countries to increase to substantive borrowing from bondholders. But I don't know if I reply. I don't think I'm answering your question.
Yeah, you have in many respects. And what you've pointed out is how complicated this all is. And this brings me to Bill. And I'm struggling right now. And I think Marina's struggling. And we're all struggling to figure out, where are we? And I'd like to run a theory by you. And this is my theory, and I want to see if there's any validity to it. And maybe there's not. But we look at the BRICS countries, and the BRICS over the past 8 years that they've been in existence have done nothing. They have a mid-level development bank to their name, and that's basically it. But the BRICS, I think, is dismissed at people's peril, because the BRICS, in my view, is now bonded by grievance. And when you hear what these countries are saying is that they're fed up with the Western financial system. That's why there's this call to make a BRICS currency. They want to de-dollarize. They want to get away from this system that's led them into where they are today, this pit. And the fact that you and Marina and experts around the world can't figure out how this safety net is supposed to work leads them into the same type of Donald Trump style grievance that says, F it, we'll burn the whole system down. And so if we don't have solutions to this, it leads to more extreme polarized politics. And I'd be interested to see where you think this failure of the global financial safety net leads us. And do you think that groups like the BRICS are a manifestation of the frustration that many countries are having in their inability to get out from under the debt and the mess that they're in?
I'll follow up on a few points that you made there. First, certainly the BRICS are indicative by communiques themselves and press releases by BRIC member countries going back, nearly a decade, indicating and articulating that they are, exactly as you put it, fed up with the multilateral system. I give the BRICS a bit more credit for what they've accomplished than you do, in the sense that not only do they have the new development bank, but they've also created the contingent reserve arrangement. Now, people are quick to dismiss the contingent reserve arrangement because it hasn't been actively lending, but they do so and really risk overlooking a series of fundamental changes within the global financial safety net over the last 10 or 15 years that point towards a shift in the way that the global financial architecture is constructed. The contingent reserve arrangement that the BRICS created is largely modeled on the Chiang Mai Initiative. Now, when people hear about the Chiang Mai Initiative, they think typically about the Asian Monetary Fund proposal that was put forth after the 1997 Asian financial crisis. And they think, well, it's not lending. And if you look at the landscape in East Asia, it's all bilateral swaps. But that doesn't mean that the Chiang Mai Initiative, which has now been multilateralized into the Chiang Mai Initiative multilateralization, isn't an important institution. They have slowly and methodically been constructing not only capacity in terms of increasing the amount of swaps, and so its resource base is, like $240 billion, but it has also been developing an institutional architecture, created the ASEAN Macroeconomic Research Office that is now conducting research and surveillance for the region and for member countries and conducting high quality economic outlooks. And these are all very important developments in the institutional evolution of the Chiang Mai Initiative multilateralization, or CMIM, but also in creating a pathway or lessons for other regional financial arrangements that want to build that capacity. The contingent reserve arrangement, because it's modeled in the same way, is really poised to learn lessons from CMIM in particular. And with an institutional architecture in place, the question that a co-author and I asked, 6-7 years ago now in an article in Development and Change, maybe not that long, maybe 5 years, was, can these institutions essentially leave the nest? Can they go it on their own? And that is still an open question. But in the case of the contingent reserve arrangement, the BRICS and also with the NDB have constructed an institutional architecture. So number one, yes, it definitely is responsive to a dissatisfaction and a frustration with the multilateral system. Two, I wouldn't dismiss it so quickly. And three, if we look at this kind of slow building momentum with the BRICS, we see, new countries that are poised to join the BRICS as members. And we have the G20 is providing a prominent forum for BRICS countries over the next couple of years. So there really is an opportunity for the BRICS to elevate their presence, to make their mark through the multilateral processes that exist with respect to the global financial architecture. But all the while in the background, they're continuing to build what they themselves have referred to as alternative institutions to the traditional Western-backed international financial architecture.
But are these BRICS institutions, these BRICS measures, big enough to meet the moment that we're in today? I see the promise and the potential, But I also see the scale of the problem as you've outlined it in your research, too.
Yeah, well, clearly our research shows that not only can the contingent reserve arrangement save the day, the IMF can't either. And that brings us back fundamentally to the challenges that the global financial safety net has, not only because of inequities in access for certain countries, in really it's the small amount of overall resources that collectively these institutions have. There isn't enough firepower. And that's what's so disappointing about the 16th General Review of Quotas. It's, encouraging to think about more permanent-based resources at the IMF. But at the end of the day, there was no increase in the firepower of the International Monetary Fund. And that is a truly disappointing outcome.
So, Marina, just finally, do you foresee that the IMF is going to maintain its kind of overarching, kind of overseeing process in debt renegotiation, or are we heading into a much more kind of fractured, chaotic kind of landscape?
I believe we are going to continue to see the IMF playing a very important role, because although we have now other sources of financing that, can help to provide global stability, especially when it's not systemic crisis. So as we discussed today, the swaps, the regional financial arrangements, the IMF still has kind of the monopoly to discuss that renegotiation. And this is a lot because they are still the ones doing a lot of the debt sustainability analysis along with the IMF. So they play not only a key aspect in, providing new financing, but also coordinating the process of the debt restructuring. Of course, we see now different dynamics that now we are going to see again how we can coordinate that restructuring with new players, with the bondholders, with China. For a long time, the negotiation was within the Paris Club. Now cannot be the case anymore because we have much new players. But the IMF still has this key role in that restructuring. And I hope that we can see, more reforms on how this is played with, changes in how we see the growth post that negotiation. So we need to, include the need to green transformation, to green financing after countries go through that restructuring. We need to see more that restructuring, the volume of the haircut for most countries, if you include green needs, we need to be higher. So we need the reform in the process, but the IMF is still a part of it.
The article is Who Will Come to the Rescue? The Inadequacies of the Global Financial Safety Net and Its Impact on Developing Countries. Spoiler alert, there is no answer to who will come to the rescue. But it is a very, very fascinating article, and one that is very important. It's on the China Global South Project website, and it's outside of the paywall, so everybody can read it. So I will put a link to that in the show notes. Written by Bill Kring, Executive Director of the Boston University Global Development Policy Center, and Marina Zucker-Marques, a postdoctoral researcher with the Center for Sustainable Finance at the University of London. Bill, Marina, thank you so much for your time today and for breaking down this incredibly complex topic and really helping us to better understand the situation.
Thank you.
Thank you, Eric and Cobus.
Cobus, my head is spinning a little bit from the conversation. It was a lot to take in. There's just a lot to process here, and it's not anywhere near as simple as a lot of people would make you think it is. You will hear in some of the Western narratives, it's all the Chinese fault. You'll hear in the Chinese saying, well, it's the multilateral fault. And I think the takeaway from the conversation with Bill and Marina is the fact that it's the whole system is just not working. And there is no answer. So this question of who's going to come to the rescue, nobody's coming to the rescue. There's no single entity that's going to come to the rescue. And I don't know how we get out of this, but if you are a poor, vulnerable country that's highly indebted, you're in really big trouble right now, and you're not politically connected. I don't know where we go from this. I mean, it just feels like Zambia is languishing out there right now.
Yeah, I mean, the recommendation in the article was essentially, if you can avoid it, try not to be in debt distress. If you happen to be an African country or global South country, it's the double whammy, right? Because on the one hand, the system itself didn't keep up with the rise of new acts, but at the same time, it also didn't really keep up with the rapid acceleration of financing need in the global South. So the system has to reform itself, which takes a long time and is very complicated to do, but there is no time because regions like Africa is hitting this kind of combination of both a huge demographic wave and a massive development and climate backlog. So there's, we need faster financing at greater scale at a moment when that's the last thing that the system can provide.
And you remember back during the pandemic when you and I were recording these shows about the various G20 meetings that were happening in Italy and then later in India. And the question of debt restructuring kept getting pushed further and further and further down the agenda. And the big powers simply were not taking it seriously. In fact, at one G20 meeting, from the finance ministers' meeting to the actual summit meeting, they literally just copied and pasted the text about debt relief. And that's it. So part of it is that the system is very complex. And part of it is that the big powers simply can't be bothered. I mean, we've seen that over and over again. It's not their priority.
Well, I think it's more than that, right? It's not that they can't be bothered. It's because they're directly profiting. There's massive amounts of wealth being transported from the South into global North economies.
I know, but do you think that influences Joe Biden's decision in terms of what's setting the priorities?
Yes, of course it does. Yeah.
You do? You think he's thinking about profit?
Who do you think are his donors?
Well, okay, so it's the financial services industry. Okay, so you're saying because the financial services industry is a major donor to the political parties in the United States, they're putting pressure on the government to say, you know what? Don't make this a priority. Don't introduce new legislation to restrict us.
That, but also just more generally, like if you're not particularly kind of concerned about inequality or developmental gaps or the possible kind of chaos coming from them, then this situation isn't actually such a big problem, right? Kind of if you happen to be a rich country, because there is this kind of regular flow of payments into your economy. And at the same time, these private institutions are lending at very high rates. So you can kind of fool yourself that they are busy helping the world by providing financing. And at the same time, kind of you can also fool yourself that everyone wins, right? Because they're being handsomely repaid. So, so from that perspective, if you happen to be in Washington and you don't need to pick a fight with this industry, very, very powerful industry who also happens to be a major donor to you, why would you? Right? If you're not being forced into kind of fighting with them, which to a certain extent, some governments now are, because, particularly in Europe, they're facing issues around mass migration, for example, right? So it's becoming politically problematic, but at the same time, I don't think many policymakers feel themselves compelled to do this, particularly when they're facing a bunch of other problems.
And then we come up with the issue of the Just Energy Transition Project. So that's called JET-P. And in a country like South Africa, where out of the $8.5 billion that was committed under JET-P, correct me if I'm wrong here, but something like 8.2 of those $1 billion was in the form of loans, right?
96%.
96%. So, I mean, here we are again, just adding more debt onto countries that we don't have a mechanism to help facilitate them in the times of distress. And then when you see countries like Kenya and the Ivory Coast and now Uganda going back into the bond markets again, what do you think?
Well, that they have very few options, kind of because bilateral lending, like development lending from governments have largely dried up. The multilateral development banks are lending, but as Marina was saying, they're very slow. It's multi-year cycles. They don't fit into political cycles in Africa. And the Chinese are all small is beautiful at the moment. So the bond markets are some of the few places where you actually can get funding for some of these developments.
With the exception of a few countries in Southern Africa that have copper and cobalt. So one of the other things that we saw this week was that the Chinese have apparently approved a $1 billion plan to refurbish the Tazara Railway. And the Tazara Railway is a railway from the Copper Belt in Zambia that goes all the way to Dar es Salaam in Tanzania. Now, this is interesting because it comes just after the United States has committed $900 million to refurbish the Lobito corridor. And you and I were talking today, when we look at the map of these new mine-to-port railways, it seems like billions of dollars are going into Africa to build railways to bring out copper, cobalt, and other resources. That's not going to help these African countries in the way that they need, because that extractive relationship, mine to port infrastructure, is literally right out of the British colonial playbook.
Yeah, I mean, it's, kind of these countries are selling these treasures for peanuts, right? Like they're giving them away, basically.
And not actually demanding concessions from the other side, saying, okay, if you're going to build this railway...
Yeah, concessions that both China and the US and Europe would be relatively... they'd be kicking and screaming, but kind of African countries, there's the rare moment where some African countries actually do have leverage to say, like, look, you want green energy, let's talk, but yeah, that's not happening.
Yeah, so that is, if you want these railways and you want these resources, then we want you to build all of this infrastructure, find a way to forgive this debt, whatever it is.
Yeah, refining or to locate component manufacturing in these countries, or like to kind of kickstart some kind of battery ecosystem in these countries. These are the few powers, like global powers in the world, that can actually make that happen. And the African countries are some of the few countries in the world who have control over these massive resources, and yet it's not happening.
Interesting that you talk about that. Just this week at the Mining Indaba in Cape Town as well, the United States signed another memorandum of understanding with the Democratic Republic of Congo. Remember, they did one back in 2022 that was to increase and to push Zambia and the DRC up the battery metal value supply chain. That never materialized. Now they've done it again, this time among the Japanese, the Congolese, and the Americans, to do exploration as well as value chain enhancement. Let's see if they're going to be any more successful. Be cautious about these MOUs. They're not binding contracts. There's no details attached to them. They're really vague promises. The one difference, though, is that the Japanese entity is a state-owned entity here, and they've already been successful in Botswana. So that may change the dynamic of this US-Japan Congolese deal. This is all part of the bigger competition between the United States and China for access to these critical resources in the Congo. The Congolese also are trying to diversify their partners beyond the reliance they have on the Chinese today. So all of that is something to think about. So we covered a lot of ground, from the complexities of debt to these infrastructure initiatives and now to these mining. It's all connected, but it's hard to stay on top of. I mean, it's really, really tough. These articles are tough, and there's no simple solution. So that's one of the reasons why what we do is so important at the China Global South Project, which is what we're trying to do is really break down this on a daily basis so that you can start to get a more comprehensive understanding of everything that's going on. If you would like to follow the work that we're doing and to keep on top of the research that's coming from the Boston University Global Development Policy Center, they publish on our site once a week. Go to ChinaGlobalSouth.com/subscribe. Subscriptions are very affordably priced. Half off for students and teachers. Just send me an email to eric@ChinaGlobalSouth.com, and I will send you the links for the half off discount rates for those subscriptions. So we really appreciate your support, and also want to give a big shout out to our Patreon supporters. We would not be able to do this work without you and our subscribers and our foundation supporters. So thank you all so much for everything that you do to make this show possible. So for Cobus van Staden, I'm Eric Olander. That'll do it for this edition of the China in Africa podcast. We'll be back again next week with another episode of the show. Until then, thank you so much for listening.
The discussion continues online. Tag us on Twitter @ChinaGS Project and visit us at ChinaGlobalSouth.com. If you speak French, check out our full coverage at projetafriquechine.com and AfriqueChine on Twitter. That's Afrique with a K. And you'll also find links to our sites and social media channels in Arabic.